Yeah, I think a recession is as inevitable as anything in the future is.
Here at Liberty in Finance, we're licensed brokers with Miles Franklin. We are standing by the inventory, ready to make sure you get what you need, even into the wee hours of night and on weekends, because preparedness doesn't stop. Call us 1-888-81-LIBERTY. That's 1-888-815-4237.
Hey everyone, this is Elijah K. Johnson with Liberty in Finance. And with us today is Adrian Day of Adrian Day Asset Management. Adrian, thank you so much for joining us today.
Well, thank you, Elijah, for asking me. Nice to be here.
Well, it's a pleasure to have you. And I'd like to mention as well that we will both be at the Rules Symposium coming here at the end of the month. And if people are looking to sign up for that, they can look in the description of this video. They'll be able to sign up for that and also support our channel along the way. So it's a pleasure to have you, Adrian. And what I wanted to discuss today first was how we're seeing a trend over many years, it seems like over the past several years, and especially really ramping up since the Russia-Ukraine war, a move away from the US dollar as the world reserve currency. We're seeing the BRICS nations looking to develop their own reserve currency, but you have mentioned that this could take a while, and it doesn't seem like there's necessarily a very obvious alternative to the US dollar at the moment. So yes, a move away from the dollar is inevitable, but it's not imminent, as you've said, and also Rick Krull has said. So your perspective on that, if you could expand on that.
Yeah, no, absolutely. Rick likes to say just because something's inevitable doesn't mean it's imminent, and I think that's the dollar losing its reserve status is a perfect case to use that illustration. By training, I'm a historian, and if you look at history, when different countries have lost their reserve, the currency has lost its reserve status, which normally goes along with the empire, however you define that, declining. It can either be a smooth, rapid transition, or it can be a long, painful transition. And the most important criterion to look at is there an obvious alternative? In 1945, at the end of the Second World War, Britain was heavily indebted, huge welfare state, bases around the world it couldn't afford. It was clear that Britain was losing a lot of its military, economic, and even political power. Then, shortly after that, we started having the colonies, starting with India, becoming, ask for independence and become independent. But in that case, there was a very clear alternative, the United States, which in 1945 was clearly the most powerful economic, military, and political power in the world. And Britain at that time more or less liked America. We weren't hostile. And so the transition was relatively smooth. You can go back to the Roman Empire, where there was no alternative, and the decline took 400 years. You look at today's situation, which is what you're asking me, and I'm sorry, I'm interested in this topic. You look at today's situation, China is, in my mind, most likely, if not inevitable, but most likely to be the leading power, 50 years from now. Military, economic, it's already going to have a larger economy than the US within a couple of years. And by some measures, Goldman Sachs says it already has. And politically. But the problem with China is, apart from the fact that, their capital markets aren't deep enough, etc., that's something that will come with time easily and can come. The biggest problem is that America, today's empire, does not want China to take over. Not only does it not want it to, it is actively hostile to that. And so I think so first of all, the Chinese markets, capital markets have to develop more. They have to have more depth. But at the same time, we're going to have some kind of accommodation between the US and China, or it's going to be a pretty bloody mess, to be honest. And I mean bloody literally, not in the British swear word sense. So that's the biggest problem. I think you're absolutely right that more and more official institutions, not just governments, but official institutions, are turning away from the dollar as a reserve asset for some of the reasons you mentioned, and with the Russian, the ease with which the West stole Russia's reserves has to make a lot of countries around the world think very, very carefully as to whether or not they want their assets in the US dollar. Because let's not forget, over the last 70 years, let's say since the end of the Second World War, there's very, very few countries in the world that haven't at some point crossed the US and the US been angry with them. So, I think more and more countries don't want their reserves in the US dollar. You've also got the SWIFT issue, of course, which is a related but separate issue, where any transfers that go through the US banking system, which is virtually all, the US claims a right to determine whether those transfers are legitimate or not in order to be allowed to go on. And we've had egregious examples. A Spanish bank that invested in a hotel chain in Cuba. Spain does not have sanctions against Cuba. This was a perfectly legal, under US law, under United Nations, if you want United Nations law. Perfectly legal. And yet the US has sanctions against Cuba, and because the money went through the SWIFT system, the US claimed the right to fine that Spanish bank billions of dollars. And there's been other cases, as you know. So that's the sort of basic framework I see. In the shorter term, of course, and I'll be shorter on the shorter term. In the shorter term, so whereas you've got major institutions, Russia, of course, is already out of dollars, has been for years. They saw it coming. China is not buying anymore. Japan is actually selling. They've sold, been net sellers, and Japan was the number one above China for some time. They've been net sellers of treasuries for 8 months now, which is very peculiar. You think they're selling dollars and buying yen, when at the same time they're actually trying to get the yen down. So they must really not want the dollar. And other countries are doing likewise. But at the same time, you've got an interest rate differential between the US and other currencies, or other major currencies, that is only getting wider as we speak. And so when you look at the dollar in the short term, trade, just, if I buy something or if I sell something, that has an impact on the dollar, number one. Number two, what we might call speculative and shorter term, trading. And number three is what we might call longer term investment. And if you're sitting in Switzerland right now, a private investor sitting in Switzerland, and you want to park $1 million, I mean, do you put it in the euro? Do you put it in the German Bund, which, wow, they've just raised their rates to negative 2.5. That's a raise, that's an increase. Or do you put it in the yen, another negative yielding currency, or do you put it in the dollar, where at least you get some return? And so the interest rate differential right now is driving short-term flows. And it will continue to do that, I think, which is why the dollar has been so strong, despite, everything probably I'm thinking, but probably you and I and many others are thinking. They've got a huge twin deficits, budget deficit, trade deficit. In economic theory, huge twin deficits should mean your currency declines. We know all the reasons why the US dollar should be weaker, but it's a matter of clean the shirt in the dirty laundry hamper. And I don't think that's going to change imminently, frankly, much as I'd like it to. I don't think it's going to, because Europe's not raising rates. Japan's not going to significantly raise rates. So we're in that sort of dichotomy between the immediate term and the longer term fundamentals.
That is interesting that we are seeing strength in the dollar, even though the longer term trend is a move away from the dollar. Now, we have seen pressure on the precious metal prices, and partly probably because of the strength of the dollar. How long do you see this continuing?
Yeah, that's a good question. Gold, frankly, this year, I think it being remarkably strong when you think it was facing the tailwind of two tailwinds of both the dollar being strong and interest rates moving up, both of which, other things being equal, are negative for gold. So I think gold had been remarkably strong for most of this year until this week. I think that's going to change when the Federal Reserve changes its hawkish policy. And I put hawkish in air quotes because I don't think it's hawkish at all. And we can talk about that if you want. But when the Fed changes its policy in any obvious way, I think gold is going to bottom and recover. That's been the history. And how long? It's anyone's guess. And again, this is a subject for probably a 3-hour discussion. But I think we'll get another 75 probably basis point raise in July. Then, of course, they have a break, which is good, lucky for the Fed, because it gives them a pause without telling the market they're pausing. It's just, they don't have a meeting, so they won't do anything, I don't think. Then you come to September. And I think a lot will depend on what's happened to the economy between now and September. I suspect that we'll get another rate increase in September. And then, cynic that I am, the next thing is the midterm elections. And once the midterm elections are over, they may decide that they don't want to quite be as hawkish as they have been leading up to the midterms. That's just my guess. So by the end of the year, I think we'll see the Fed at least pause.
And you've mentioned that the Fed cannot bring inflation down without causing a recession. And we might even be in a recession right now if you look at the numbers from the Atlanta Fed. But your perspective on that, kind of the inevitability of a recession now?
Yeah, I think a recession is as inevitable as anything in the future is. I mean, obviously things can change unexpectedly. But yeah, the first quarter was negative GDP, as we know. And of course, there were 101 excuses made for that, some of them valid. The second quarter doesn't look too good. As you said, the Atlanta Fed is predicting a negative GDP. But I definitely think we'll be in a recession. If we're not in one now, we'll be in one by the end of the year. There are conflicting reports, of course. I mean, today's jobs number, at least the headline jobs, was relatively good. More jobs than analysts were expecting, and the unemployment rate stayed the same. But, if you look behind that, there's some worrying things. First of all, they downgraded the number of jobs for the last 2 months. So that makes you wonder, was today's job number actually accurate? Number two, even though the unemployment rate stayed the same, the participation rate went down once again. If the number of people in the job market goes down, your unemployment rate can stay the same, but you have fewer people working. And then the third important factor is that even though the number of jobs in today's jobs report actually went up unexpectedly, earlier in the week we had the new claims number. And the new claims number has been moving up now for the last, don't quote me on this, 3 or 4 months anyway, at least. And so, that's, I guess what I'm saying is that the economy is not all in one direction at the moment, but even the good news is not as good as it appears on the surface. And then, of course, you've got, housing, a number of, the supply of housing moving up as new purchases go down, automobiles going down. You could look at statistics across the board, and it's all pointing negative right now. And then, of course, in the next month, we've got corporate earnings. We don't know what they're going to be. I don't think they're going to be as good as analysts are expecting. Analysts are expecting a better than 14% jump in earnings for the S&P. I don't think that's going to happen. You know, a year ago, we weren't fully back to work, but we were already pretty open a year ago. But that will have some kind of impact on the economy, because if earnings decline, more companies are going to start retrenching, are going to start laying off, or at least not hiring, postponing investment, etc.
Now, you've mentioned on your website under the Insights page, one of the posts you wrote was, you mentioned that the current economic environment is really worse than what we saw during the Volcker era, when they had to raise interest rates to, over 19%. You say the debt levels, asset prices, they're all worse than the Volcker era. So your perspective on that, and how does someone navigate this if they're looking to invest and grow their wealth?
Yeah, no, good point. I mean, if you're a Federal Reserve and you want to raise interest rates, the things that might give you pause are the level of debt, because obviously as interest rates move up, it becomes more difficult for some people to service debt, and it certainly becomes, and I know most debt today is fixed rate, but of course, if you've got your corporation with $500 million worth of debt that matures next month, you're going to have to roll that over. So interest rates moving up does have an impact on debt. So the amount of debt outstanding has an important factor. Asset prices are important because asset valuations, as a broader point, don't tell you whether a market is going to go down or going to go up, or certainly not when it's going to go up or when it's going to go down. But asset prices give you a good idea of how much potential or risk is in the market. I don't know if I explained that properly. So when valuations in the stock market, for example, are extremely high, other things being equal, in normal times, it doesn't mean they can't continue to go higher, but it does tell you how much they could fall, what the potential is. And so that's another factor that will give pause to raising rates. The more you raise rates, you're going to cause asset prices to come down. But if asset prices in many instances are at all-time historic highs, certainly bonds, certainly equities, and many other asset prices as well, you've got a lot more room for asset prices to fall, which again has an impact on the real economy. So yes, it's from the point of view of a central bank looking at raising rates, this is a far worse economic environment than Volcker faced. Number one. Number two, it's a matter of personality. I mean, Volcker came in with a mandate to cut down inflation. Now, Biden's got his marching order. Powell has got his marching orders from Biden to cut inflation, but I don't think he's of the same, how should we put it? I don't think he has the same stomach for it that Volcker did. So at some point, they're going to pause and then turn around is my guess. Now, I have disagreed with a lot of my friends in what we'll call the hard money movement, who didn't frankly think would get as far as we have with interest rate hikes. But I suspect that they will carry on for a little while. The Powell Fed isn't too interested in the stock market declining. Previous cycles, 2005, 2013, 2015, 2018. As soon as the stock market fell, the Fed caved. I don't think this Fed is concerned with asset prices. They're not even overly concerned about the economy in general. I think what they are concerned about, what will cause them to pause, is either severely higher unemployment, to the point where most people are more concerned about unemployment than they are about inflation. And at the moment, people are more concerned about inflation. And number two is systemic risk. And that was their big claim for 2008, of course, not a recession, not a stock market, but a systemic risk. I think they overestimated that, frankly. But if they see the risk of some kind of systemic failure, some failure that will affect the entire economy, I think they will turn on that. And we don't know what that'll be. That'll come out of the blue, but it might be a bank. Interest rates move up, credit card defaults increase, loan repayments decline. We don't know. Some bank somewhere, might have a problem.
And again, then investing in this sort of an environment, your perspective?
I mean, a lot depends on, what kind of investor you are, how nimble and you want to be as opposed to a longer term investor. I mean, right now, I think gold would be the number one asset to own. And I've always said people should have physical gold before they start playing with gold stocks or, futures or options or anything else. Gold, as you probably know, I'm sure you know, gold has been the best performing asset in stagflationary periods since the 1960s. And we've had several of them. The most important, of course, the most significant was 1976 to 1980. Oil did very, very well in that period, but of course we had an Arab oil embargo, so that helped oil a little bit. But gold has been the number one asset in all of those environments, followed by commodities generally. So gold is definitely the number one asset to own. I suspect most of the people watching this already have their gold. But I wouldn't be overly concerned about short-term volatility. Stocks, I think we're setting up for a very good rally in the stock market. I think we're in a bear market. Bear market rallies tend to be strong. They tend to be powerful, and they tend to surprise people. I think we're setting up for a rally in the stock market. I'm talking short term now, as someone who does this every single day. But beyond that, I look at what's the risk, what's the potential in the stock market, and it strikes me that there is a lot more risk in the stock market right now. And I talked about that in one of my letters. If you look, I mentioned earlier that the analyst S&P estimates are an increase in earnings of 14%, more than 14%. So let's just make two relatively conservative assumptions. Let's say, for example, that earnings stay flat. They're the same as they were in the last 12 months. And let's say that the S&P earnings multiple contracts from over 19, which is lower than it has been, but on a historical basis, that's still a high multiple. Let's say it contracts from 19 to 17. 17 times earnings is not a low multiple. I'm being very, very conservative with these assumptions. So if those two things were to happen, the S&P declines another 27% from where we are now. So I'm not talking about, earnings crash. I'm not talking about, the end of the world or anything. But we've got another 27% decline on those conservative assumptions. And of course, in a bear market, things often swing to the opposite side. The earnings multiples will contract more than they did, say, in the 2006-2016 period. 17 would have been a high multiple in that decade. So anyway, I'd be very cautious on stock markets. And typically, again, in a stagflation, developed market stocks do badly. And what does well are smaller market stocks. But with one proviso, and the proviso is that typically smaller market stocks do better when the dollar is weak. So if we haven't had a period like this where the dollar remains strong. So we can't look at history as a guide. We have to make assumptions and hypotheses. I suspect that people want to be very, very cautious in global equities right now, global including the US.
All right. Well, Adrian, thank you so much for your time today. Before I let you go, where can our viewers find you online if they're interested in learning more?
Yeah, the website is is www.adriantayassetmanagement.com.
All right. Thank you once again, Adrian. And it'll be a pleasure meeting you at the Rules Symposium. Once again, a link in the description of this video if you'd like to sign up. Thank you so much, and God bless.
Well, thank you very much for having me. I appreciate it.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty in Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.